What's going on, traders? This is Stephen Place with Precision Volume Alerts, and welcome to Watchlist Wednesday for Thursday, September 30th, 2021. If you're wondering why I'm doing Watchlist Wednesday on Thursday, is the watch list I was going through kind of sucks right now. Market's a little bit soft. You know, we're going to look at electric vehicle stocks, and they're not running. So we're just going to move on right now, and we're going to talk about something a little bit more important in the very, very short term, and we're going to discuss volatility. So your watch list today is going to be the 10-year yield or 10-year futures, the VIX, the VVIX, and the VIX futures market. 5 years ago, you didn't have to care about this, right? Sure, some option traders would use it, and the fear indicator, the VIX, can be a useful indicator, but we have seen such a shift in the liquidity dynamics of this market that the options market can and does drive stock price movement. On the S&P, like, we're not talking about GameStop or AMC, we're talking about the broad indices. The price action is being driven by some factors around the options market. We've known this for a couple months now. We have seen weakness around the S&P, around monthly options expiration for 5 or 6 months in a row. That pattern's finally breaking, but we are getting to the point where the market is soft, but we have so many people that are hedged up right now, it's very difficult to see downside. So let's go ahead and talk about this. Let's hop over to, let's talk about the S&P really quick. And we'll use the spiders. We did finish near the lows relative to last Monday's pullback. It's a pretty strong move. We're seeing basically a continued rollover. There might be a secondary push to around 42.40. That's going to be the measured move to the downside, along with previous price support as well as previous price resistance. Okay. Now, when you get a market where everyone is exposed, you see a lot more downside action. When everyone panics and buys hedges, then it becomes much more difficult to see further downside. And we absolutely did see that last Monday, where we didn't get any push to the downside. And then there was this massive counter trend rally to fill that gap, come into the 20 EMA, and then roll over again. The reason it's difficult for this market to truly sell off is because, let's take a look at the VVIX. This shows us the demand for VIX options. And when we get a spike in the VVIX around 140 to 145, that has put in near-term bottoms in this market. Obviously, it's a little bit different. It's a different flavor over the past 2 weeks. But if you compare the price action in the S&P right now, which is a retest of last week's lows, and where the VVIX sits, it's nowhere close. Why? Because those that needed to hedge already did. They don't have to re-hedge, so you don't see that spike again. You don't see that massive push higher, that massive continuation. If we zoom this out a little bit, you can see that during the crash in March 2020, this sucker went all the way up from 150 to 205. So that's the kind of crash we are used to seeing. If you back this out even further, you can see how we've established a new range and a new expectation of how VIX options are priced. Why? Because there's no liquidity in this market, all right? Or at least it's much lower than what we're used to. So the lower end's around 100, the higher end's around 140. On an intermediate term basis. So for me, that's a couple weeks out. I am not too concerned about further downside price action in equities if we don't see a continued pop-off in VIX options. The reason for this, if we see continued downside, and let's just say the VIX pops, the VIX runs to 30, right? Or maybe 35. The investors and traders who picked up hedges during last Monday will start to offload those hedges. They will start to sell their VIX positions. And that trickles back into support in the S&P. It creates a natural floor in the market. All right, so there is a very distinct risk expectation divergence between the current price action in the S&P and where we sit right now in the VIX or the VIVIX. Remember, this is for the demand for VIX options. Now, if we go look at the actual spot VIX, and this shows us the demand for S&P options, again, we're not there. We haven't seen a break above Monday's high, which is right around 28. We continue to see persistent supply as the market continues to sell off. And unless this breaks, let's just say we get some news, maybe Evergrande becomes a really big contagion issue, or maybe bond market vol really starts to pick up again, then that can start to spill over. And if we get a VIX above 28, then it's time to be a little bit more concerned. But we're not there yet. We're not seeing that kind of move in the volatility markets. Again, my contention still is that the options market is driving a significant amount of price action in the indices right now. That's just what we're seeing. So unless it's an if-then, basically, if we don't see a push above 28 in the spot VIX, it becomes very difficult to see further movement to the downside in this market. Okay. Now I know, look, I'm going to look like an idiot if this market rolls over, right? That's just how it's going to work out. But that's what I'm seeing. Okay. And that's what we are, that's what's being laid out in the market right now. You can also look. So another part of Watchlist Wednesday tonight is VXN. This is the VIX for the NASDAQ 100. A lot of tech is a little bit more top heavy. If rates continue to rise, that'll probably lead to continued softness in tech. And we might actually see an overtake of the Monday high on VXN, which is right around 30. Again, unless that happens, you probably in the intermediate term should not be concerned about a ton more downside action until those hedges have burnt off. Once they burn off, it's anyone's guess after that. It could be fair game for serious downside unless we see a persistent bid in hedging instruments. We can also look at the VIX term structure. And I know we're going down the serious rabbit hole, but this is very important to understand in this market right now. You can tell I have a kid because I'm being targeted for the new Boss Baby movie right there. This is the VIX term structure. So the green dotted line is going to be the spot VIX, which we've been talking about. It's 23. The near-term VIX future is currently at 22.5. The November VIX futures at 23 1/3. The December's at 23 3/4. So this shape of this curve is called contango. And this is a very normal curve. This is what you see in markets where the condition is not ugly, right? It's not showing us drastic moves to the downside. So if we were to look at, I'm not sure I can pull this up just yet, but if you were to look at how this looked back on Monday, it's probably going to look a little bit different. I'm just going to pull this up really quick. I'm going to try and shoot from the hip and do this live. What was Monday? 20 SEP. So we're going to go here. We're going to go 2021. We're going to go 20 SEP. And we'll get prices. It's still not content. It's still not backward. All right. So it's one of those things that has been baffling a lot of volatility traders and a lot of option traders, including myself, that with this kind of movement to the downside, we haven't seen a whole lot of sensitivity in the VIX futures curve. Yes, we're at 24, we're at 28, we're pretty high on an absolute basis, but the overall curve it's very telling because normally when we have very short-term catalysts, like we've got the debt ceiling coming up in October, you would think that the October VIX future would be at a higher value than November, but it's not. It's very tame right now. Again, unless that shifts, we need to assume that the overall downside is capped in this market. And I know that's not an easy thing to say. And downside here, I'm basically saying, we can go another 2 to 3% to the downside and still have what we would consider normal market structure. I'm just not expecting any kind of cascade further down from that. I could be wrong, which is fine, but that's just not what the indicators are currently showing us right now. One more thing for our watch list, and I know this is a little bit more macro, but you should absolutely be watching the 10-year right now. All right, this is the 10-year bond market. And you can look at longer dated stuff. We're looking at ZN. You could also look at ZB as well. The basic premise for this is that when yields go up, that means bonds are selling off. That is bad for tech. It's good for banks, good for energy stocks, good for commodity stocks. And we've seen that. If you look at energy stocks right now, Conoco's on a run, Devon Energy's on a run. If you look at ag stocks, CF's been running. Monsanto has been running as well. Monsanto or Mosaic? Mosaic, MOS, has been running as well. So if this, the thing about that is, the S&P has such a low weighting in energy stocks and materials stocks and things like that it's not going to affect it. It doesn't matter how far Conoco or Exxon or those large oil names run. They account for like 10%, 15% of the weighting in the S&P right now. If we see a bounce in bonds, that means yields start to drop. That is generally better for tech stocks. And 35% of the weighting in the S&P is 5 or 6 names: Apple, Amazon, Facebook, Microsoft, Google, and Tesla. All right. For the NASDAQ, that accounts for about 50% of the weighting in those. So if tech starts to bounce, mega cap tech starts to bounce, it's going to drag the overall market kicking and screaming higher. You get that combined with way too many people selling calls. You get that combined with way too many people buying hedges. And there's all sorts of weird option dynamics with respect to Charm and Vanna that come into play. That's how you get the downside capped. Okay. I prefer further downside. I don't see it just yet. We're not there yet. So those are the things I'm watching right now. And that's what I'm going to be watching headed into the end of this week. That's what I'm going to be watching at the beginning of next week to see if this downside move can be contained. And if we don't see a massive overreaction in the volatility markets, it probably will be. Okay, so that's what I've got right now. Thank you so much for watching this Watchlist Wednesday. If you want my trade setups and when I take trades and the option trades I take with it, if you'd like to see how we do that and how I use my roadmap to find the most profitable trade opportunities out there, we have a free training below this video. Is access to a free class that we've done, a masterclass on using a volume roadmap to find key magnet levels as well as key support and resistance that most people don't know about. And then you can use that to structure your option trades for massive moves. We just had a trade set up where the stock went up 7%, but our options went up 56% because we know the right kinds of strikes to choose and the right kinds of durations. So do the free training. Once you get done with that, you can get access to the Precision Volume Alert service. I highly recommend you pick it up. And that's all I got for now. Thank you all so much for watching this. I'll see you all next week. Have a great day.